The ECB kept interest rates on hold today at 1%. The decision was in line with forecasts by analysts who predicted the bank would pause to assess the impact of its back-to-back cuts in previous months. For his analysis, I'm joined now by the head of market economics at NAB, Tom Vosa. Tom, thanks for joining us. I want to start with the ECB's conventional policy. Draghi said that the ECB never pre-commits, but he also said policy will remain accommodative. Does that mean a rate cut is guaranteed next month?
No, I don't think it does. If policy weren't accommodative, then arguably there is perhaps a chance of a rate cut. After all, looking at the Eurozone losing momentum in the fourth quarter and perhaps contracting in the first, it's where a bank should be cutting rates on conventional monetary policy means if it believes that policy is too tight. Instead, we were told that interest rates were accommodative, they're at a low level. I think there is scope for another rate cut, but it's now conditional. The economy has to grow by less than the ECB believes. Really, the opening time for that would be March when we get the new set of staff forecasts, and I think even then it's not likely. I think for now we are at 1% and we're going to stay there.
But he did say that the risks to growth were very much to the downside.
They are indeed, but we need to see a much weaker level. I think the trigger now for any perhaps future rate cut would be a fairly disorderly event in Greece in the middle of March. If we don't see essentially the funding coming through, if we look towards a disorderly Greek debt default, then I think we would see the ECB step in and give a little bit more monetary stimulus to the economy. But I do think that's quite a high hurdle and we're not going to get it anytime soon.
OK, I'll come to Greece in a second, but I just want to ask you about other unconventional measures. He was very upbeat about the success, as he sees it, of the long-term refinancing operations, the 3-year liquidity operations. Can we expect a similar take-up in size as to what we saw in December at the operation next month?
I think it could indeed be even larger. In December, the banks had just been told they were going to get a 3-year money. Didn't really have enough time to start putting together the assets that they would need as collateral. They've had a couple more months. We've seen an awful lot of covered bond issuance and perhaps some internal synthetic securitization. The ECB will take raw loans as well. So we think you could even see up to €1 trillion worth, so double the amount taken in December being used in February. It basically allows the banks to fund themselves fully for this year and next, and hopefully that money gets pushed into the real economy.
€1 trillion. I mean, you could look at that two ways. One way would be to think, OK, the banks are taking advantage of the current conditions and accessing that cash. Or you could think, well, the banks are in real trouble.
I think it's basically a mixture of both. We know that wholesale funding markets are effectively shut, so where do you raise cash from? You still have quite a lot of illiquid assets on your balance sheet. The only person that will take them, because they can transform it through maturity, is the ECB. So that's what you do. Remember, banks are being encouraged to lend. They're also being told they have to raise their capital ratios without selling assets. So what else can they do but to park it in the ECB? The interesting point that Draghi made today was that the people who are borrowing from the ECB are not the same who are depositing cash. The message he's keen to get out is that the interbank market is certainly impaired, but it's not broken. So that's essentially the ECB's hope that over time an awful lot of liquidity into the system will feed through to the wider economy.
But banks took up nearly €500 billion of that funding from the ECB, and if they're not the ones putting it back in overnight deposits, which are also close to €500 billion, who is?
Well, we suspect it is going to be some of the non-financial corporates. In other words, the banks that only exist because they are the other hard side of large Eurozone corporates. We know that their corporate profitability has been extremely high in this recession. We do know that companies are carrying some fairly healthy balance sheets, and the suspicion is it's corporate treasurers who are getting very nervous, who are parking it with the ECB rather than putting on deposit with the banks. And that, of course, means that banks themselves become more reliant on ECB funding to make that whole. So I do think, again, what he's trying to say is, yes, there is probably some round tripping. It's not as large as the market thinks. This policy is working, just not as perhaps as quickly as they might have ideally liked.
Two quick questions to finish up with, Tom. Draghi said hardly anything about the ECB's bond buying programme. Do you think the ECB will buy fewer bonds, step back from its bond buying, given the apparent success of the LTRO?
I think their bond buying programme is entirely opportunistic. If we start to see upward pressure on yields, then the ECB will step in. We know they have a very limited appetite, and there are clearly some members on the council who would prefer that they never got involved in the whole process of bond buying. So really, the lack of question today and the lack of comment reflects the fact that the Spanish auction was relatively successful, and we're not seeing the kind of upward pressure on yields that we had in November and indeed in December. But should markets start to push yields higher, the ECB will come back in. I think they're just reluctant to do so and will continue to do so opportunistically.
And finally, Tom, in a word, we had comments from Fitch yesterday warning that the ECB must do all it can to avoid a cataclysmic collapse of the euro. Do you think the central bank is doing all it can?
I think in terms of what, it's providing liquidity to the banking system at a cost. It's essentially taking whatever they've got as collateral in exchange for that cash. That certainly, as a lender of last resort, it's doing its job. Should it be they're doing more perhaps on quantitative easing? Well, it's a moot point. The ECB would argue it's not allowed to do that. That's monetisation. It's against its constitution. And indeed that in reality any movement on the sovereign debt crisis needs to come from politicians who so far have been reluctant to bite the bullet. So if you put those two constraints together, the ECB has limited scope for manoeuvre. It's using it. Would I like to see a firmer commitment to QE? Well, yes, I probably would, but I don't think we'll get it because certainly we don't want another German board member to resign.
OK, that's all we have time for. My thanks there to NAB's Tom Vosa. That's all for now, but join us again at 4:30 London time when we'll look at what's likely to drive trade in Europe on Friday. I'm Jamie McGeever. This is Reuters.